Another measure of profitability is return on equity. We know return means net income. And of course, equity refers to total stockholders' equity, average total stockholders' equity. We want to, when we're doing ratios, we want to compare net income to some measure of the company's size. And the two commonly used measures of the company's size when you're looking at financial statements are assets, and we saw that with ROA, and stockholders' equity, or ROE. How much income was generated from that stockholders' investment? Now, this is typically used by the common stockholders, whereas anyone might be interested in return on assets, ROA. The common stockholders are the ones that are looking at ROE because they're saying, how much income was generated by my investment? Remember that the common stockholders are the ultimate owners of the company. They want to measure the efficiency or the effectiveness of their investment. And what is that investment? What do they want it to do? They want it to generate net income. Notice that ROE looks very similar to earnings per share. But what are the differences between earnings per share and ROE? Earnings per share is net income minus preferred dividends. So ROE ignores preferred dividends in the numerator. And what about the denominator? Earnings per share. So the denominator is also relates to shares of common stock. But whereas ROE is stockholders' equity from the balance sheet. This is the dollar amount on the balance sheet. Earnings per share is the S in earnings per share is equal to the average number of common shares, number of shares of stock, compared to the dollar amount. Remember, what is the dollar amount of how much cash did the company get when it issued its common stock and preferred stock, if there was any, plus all of their income that got reinvested, less any dividends that were paid out, reinvestment in the company, the retained earnings, plus or minus any accumulated other comprehensive income, and less any treasury stock. Total stockholders' equity can also be called the book value of the firm. Sometimes you'll see that term. It's also equal to the company's assets minus liabilities. So from the owner's perspective, if we took our assets, converted them to cash, paid off all of the liabilities, what would be left for us of this company? The book value is different from the market value. The market value of a company, another way to look at performance of a company might be to look at net income compared to market value of a company, but we don't see market value on the financial statements. The market value of a company is equal to the stock price at a moment in time times the number of common shares outstanding. And since market price, market value is not part of the financial statements, it's not part of our ratio analysis. Let's look at ROE for Walmart and Costco. Walmart's net income $15,511, average stockholders' equity $80,277. This works out to return on equity of 19%. And how about for Costco? Net income $6,292, average stockholders' equity $22,850, 28%. All right, so we see Costco in the lead again, the higher return on equity. Total stockholders' equity, return on equity can be broken down into three components. We saw that return on assets was broken down into two drivers, ROE can be broken down into 3 drivers. Which is helpful because it helps investors and the company's management to get a better understanding of what caused an increase or a decrease in ROE, or how one company's ROE, why it might differ from that of another company's. And we call this, when we break it down into the 3 components, we call this the DuPont ROE. And the 3 components are profit margin, asset turnover. So far, this sounds pretty familiar, doesn't it? We know what profit margin times asset turnover is. That gives us ROA. So we're multiplying for ROE, we're multiplying ROA times something called the equity multiplier. And the equity multiplier is average total assets divided by average total stockholders' equity. And we know what these other items are. Profit margin is equal to our net income over sales, net sales. How profitable were our sales? Asset turnover. How well did our assets help us generate sales? And when we multiply this by the equity multiplier, we'll get back to our ROE. We can see that's why this works. If we cancel out this sales and this sales, and we cancel out our average total assets and our average total assets, we get net income divided by average total stockholders' equity. But before we continue, let's take a look at this equity multiplier. This indicates, it tells us about the company's reliance on equity to finance its assets. Remember, assets can be financed in one of 2 ways, liabilities or equity. Reliance on or use of stockholders' equity to finance assets. And stockholders' equity as compared to or instead of or versus. Companies are going to use some mixture of liabilities and equity to finance their assets. Think about return on equity, the net income being the same. Return on equity is going to be lower the more the company relies on equity. The more the company can rely on liabilities to finance assets, the higher that return on equity is going to be. So the greater the use of equity, think about this ROE formula, our net income divided by total stockholders' equity. The higher the denominator, the lower the ROE. And of course, the greater the use of debt or liabilities, well, that's really good for the stockholders, because net income is going to be the same regardless of whether you're using equity or liabilities, other than the fact that liabilities, long-term debt comes with interest expense. So aside from that, if net income is the same, the more we use liabilities, the higher return on equity will be. So you're thinking, why not just use all liabilities and as little equity as possible, just because of that little thing called bankruptcy risk? And we'll talk about that more when we look at solvency for the company. Let's look at these amounts let's start with Walmart. We have we're going to take the DuPont ROE equal to profit margin times asset turnover times the equity multiplier. And for Walmart, this is going to be equal to, so the profit margin was 2.4%, asset turnover, 2.6, a number, not a percentage, a number of times. And the equity multiplier, that's also going to be a number of times. How many times greater were your assets compared to your stockholders' equity? So we're not going to look at this in a percentage, but a number of times. The equity multiplier, assets were 247,798, and total stockholders' equity 80,277. So our equity multiplier works out to be 3.1. Assets were 3 times as great as stockholders' equity. I want to point out that the greater the use of equity, what we're going to see is the more equity that's used, the higher the equity multiplier will be. So an equity multiplier, higher values indicate less use of equity, because we're saying our assets are 3 times as great as our stockholders' equity. If the equity multiplier were to be something like 10, we would say our assets are 10 times greater than equity. We're not using much equity. And the higher this number, the equity multiplier, the higher the ROE. Okay, so to summarize, the more equity that's used, the lower the equity multiplier and the lower the ROE. The lower equity that is used, the higher the equity multiplier and the higher the ROE. All right, so when we multiply this out for Walmart, their profit margin times the asset turnover times the equity multiplier, we get 19%. So all we did was take our ROE that we saw above of 19% and broke it down into its 3 components, or we can look at it as 2 components, ROA and equity multiplier. Let's do the same for Target. Sorry, not talking about Target. Let's do the same thing for Costco. Costco had profit margin 2.6. Okay, so better than Walmart. Asset turnover 3.6. Again, better than that of Walmart. And Costco's equity multiplier 66,580 in assets, 22,850 in total stockholders' equity. So Costco's equity multiplier is 2.9. So it's just slightly lower than that of Walmart. So let's see. This works out to be 28%. All right, so even though they didn't use quite as much equity, they still did much better, and we can see the resulting output was a significantly higher return on equity.